Hey, what's good, guys? So this is the first J Snipes YouTube video. I wanted to make this video about how I determine trading ranges and how that helps with my directional bias. That way, in the future, when I get into some trade breakdowns and other videos, it will help you understand a lot more why I'm marking things out the way I am, and it'll just be a lot easier for you guys to follow. So before we get into the video, just quickly, if you guys can, give me a follow on my Telegram channel. It will be the first link in the description, or you can just search up J Snipes FX and give it a follow. If you don't want to, that's all good as well. Alright, let's get into the video. So the trading range is an ICT concept, so all credit to him. I'm just explaining my view on it and how I use it to trade. So let's go with this. So when we have, this is market structure I'm drawing now. So we had a break of that there, so we're going bullish, and then we have a break in the opposite direction. So here's our first break here, and then the next break in the opposite direction is here. This will give us our trading range. So from this low to this high. So once I see the opposite direction, I know that's my trading range. I'll then take my fib and I'll draw out this. So I want to be looking at buys below 50%, so in a discounted price. Okay, that's the main concept with the trading ranges. So then you can look at point of interest in here, or sweeping liquidity, which is under these old lows. Whatever it is that you do for your strategy or your trading technique that you enter, you can use that in here and then look for high prices. So what I would do, wait for price to move lower, can go in here, break structure here. So then let's say you wanted to get a confirmation entry, could break structure there, then it goes back down, you enter somewhere in here, and then you'll go up and take out this high. So this will be a strong or protected low, so you wouldn't expect this to get broken, and this would be your weak high that you would target. So you would look to buy and then take it up to here. So that's basically the trading range and how it will help with directional bias, but it's the opposite way around for a bearish trading range. But let's go on to the charts. It's been very bearish, so I can show you some live examples. Alright, let's go back. I guess here is where the bearish prices started, so we can just start there and I'll show you a few examples. Okay, so what do we have? So very important is the concept where the protected or strong highs. So that just is when there's a grab on liquidity, so a sweep of liquidity, and then a break in the opposite direction. So for me, I like to see a candle body break a low. That's how I view market structure, not with just the wicks. Okay, so then now what we wait for, so this is our high of the range, and then now this is, here's a swing high that's broken. So a swing high is simply, if I zoom in here, I'll put this away for a sec, the wick here is higher than the wick to the left and right of it. So that's what a swing high is. Okay, so now we've had that break in the opposite direction. Now we have our trading range from here, from there to there. Okay, so this helps us. Also, why is it not up here? This gap is really big. Price doesn't come back into these areas. So I'll take the next high closest to it and then make that my trading range. And what's also very good with trading ranges is that you don't have to focus on anything to the left. You have this range. This is the only bit of price action that you're focusing on. So this is a daily trading range. And then this will give you your bias for quite a long time. So now we draw out the fib. So now we are only looking for entries above 50% in premium. Okay, so whether it be you're taking out liquidity you want to see, or you're entering off order blocks or gaps, that's up to you. A safe place to put your stop loss will be above the strong or protected high. Okay, so then price goes into 50% and it drops nicely. Okay, so that's one example. We'll just keep going through a few. I don't want to make this video too long, and I don't want to bore you guys, but it is a very important concept. It's simple, but does require some back testing so you can see it live for yourself. So we have a sweep of highs here. So this would be a strong high, but we need to wait for it to break the opposite direction to get our trading range. Okay, so then what we get here is our break in the opposite direction. Get that body now. And then, so now we have our trading range. So we have a high here and a low here. We had a sweep of this liquidity. Okay, so we got protected high and the weak low. So now draw out the fib, 50%. We know we're only looking for an entry above, so in here, and then we're expecting price to go lower. So mainly I'm not taking entries on the daily. I go onto lower time frames and look for pretty much the same thing to happen, just lower time frame trading ranges, but I use the daily to give me the bias, which is now bearish. So that's showing us the direction. So in this case, price actually did go and just, if I zoom in, just wicked above it. But a wick is not enough to make it basically for us to go, oh, okay, we're going to be bullish. I want to see a body break. In this case, it was just a wick, and then look at the reaction. 3 bearish days after. So we can assume that we're getting those bearish prices, and we're looking for shorts for the next. I mean, if you look at it, after this, so until it broke, you had 22 days. You had almost a month worth of, well, yeah, 20 days is 20 trading days is a month. So you had a month of understanding where price is most likely to go. Okay, and then we had a break of structure again. So now we're waiting for our trading range. So now we've had here quite a big drop. So we're not going to probably take it from here, our trading range high, because this is an energetic price swing lower, meaning there's a big gap there. So it's not as likely that price is going to come and fill this all up and keep going higher. So we'll just wait and see what happens. So it's touching into that gap, goes lower. Okay, so now where I would like to draw my range high from is here, where it started this big push down. And then why is that the high and that is the low? Because we had the break in the opposite direction. So if I zoom in quickly here, we had a high that broke the low. We had this high that broke this low, and then it broke higher. Okay, so that's our trading range now. From here to here, can draw out our fib. Now we've got our 50%. So we know we're only going to look for prices above there. That means you're not going to take a trade off this order block, because this is most likely going to fail. Also, if you wanted, you could actually look to buy up now into premium prices. So you've got the 2 down closed candles, which is an order block. So you could look for a trade off that. So I would just, yeah, you could look off here. There you go. Touches the body, shoots up into here. And then you could either look for a trade off the gap, off the order block, and then a safe stop loss will always be at the strong high. Okay, but this is just, we're just using this for directional bias, the daily. Okay, if you trade off the daily, then that's fine. Personally, I don't. Okay, so we had here, it came up. We even had some trend line liquidity here. So this was like a perfect example of oops, yeah, price taking out this trendline liquidity into the order block, the body where that's where the volume is, and then shorting down again. So yeah, as you can see, it's pretty powerful tool for determining directional buys. Just going to do a few more examples, and then yeah, I hope you guys get the understanding of it, and then it will just be up to you to back test it, and I'll do more videos showing it. Okay, so again, what do we have? We have a break, a big push down. So instead of this being the high, I'll just take it from here, and we wait for that break in the opposite direction. So we get that here, and then we also have, so now, whoops, I should mark out this. So that was the high that caused this big push down. Here's the low. So now I'm wanting to see price go into premium before it goes back lower and takes this out. Now this is just a wick break, so it's not as high probability for me. Doesn't mean it can't work. My rules, I want to see a body, so I'll be very cautious here. So for the next month, I remember this price action. It was just consolidating, so it was really choppy, pretty shitty price action. But even still, if I draw this out, we can know that if this is our trading range, in this area we're not going to look for any big shorting opportunities, because it's most likely needs to come into a premium before it does so. So even in choppy price action, it can be quite useful. So let's see. So price goes up. These are relatively equal highs, which will be where liquidity lies. So it takes that out in 50% in premium, and now most likely will drop down. There you go. Alright guys, so I'm going to leave it there and let you guys back test it for yourself. If you have any questions, please just hit me up in the comments. I'll be happy to answer it. And yeah, next I guess I'll show you guys how we can get the reversals here on the lower time frames. There was a trade this week that was really beautiful that I can break down. It was about, where was it? It was here. How you could have caught this high and caught this move down on a lower time frame. So that will be the next video I upload. Hope you guys liked it. Feels weird saying like, comment, subscribe, but yeah, just do whatever you want to do, and yeah, hope it helped. Till next time, bye.